Japan's economic story is one of astonishing highs and sobering lows. In the span of a few decades after World War II, Japan rose from smoldering ruins to become a global economic powerhouse. Yet today, it's often defined by the term lost decades, referring to a long period of stagnation and deflation. This script explores how Japan achieved its post-war economic miracle, how an epic financial bubble in the 1980s set the stage for collapse, and why the aftermath led to decades of economic malaise. It's a journey through history and policy, one that holds important lessons for economists and policymakers worldwide. By tracing Japan's meteoric rise and protracted fall, we'll uncover the structural flaws in banking, monetary, fiscal, corporate, and immigration policies that left a once unstoppable economy stuck in neutral. The tale is both inspirational and cautionary, showing how even the most dynamic economies can falter. Japan's post-war rebirth is nothing short of extraordinary. In 1945, the nation lay in devastation, its cities firebombed, industry shattered, and people struggling to survive. Under U.S. occupation, sweeping reforms were introduced: land redistribution, democratization of institutions, and initially, the breakup of powerful conglomerates, zaibatsu, to prevent remilitarization. Yet as the Cold War set in, U.S. policy shifted from punishment to partnership, aiming to rebuild Japan as a bulwark against communism. American aid in the outbreak of the Korean War in 1950 provided a timely boost. Supplying U.S. forces in Korea became a lifeline for Japan's heavy industries. Factories received orders to repair vehicles and produce war materials, jump-starting industrial production. By 1952, with the end of occupation, Japan had been reintegrated into the global economy, laying the groundwork for a remarkable recovery. Industrial output, which had plummeted to a quarter of pre-war levels, roared back. By 1960, it reached 350% of its pre-war output. In just over a decade, a nation on its knees had rebuilt its economic base, an achievement so striking that it earned the moniker Japanese economic miracle. The 1950s and 1960s cemented Japan's status as a rising economic star. Powered by a diligent workforce and guided by smart government policy, Japan's economy grew at an annual clip close to 10% between 1957 and 1973. Policymakers like Prime Minister Hayato Ikeda launched bold plans, notably the Income Doubling Plan, aiming to double GDP per capita in a decade. Industrial policy was orchestrated by the famed Ministry of International Trade and Industry, MITI, which funneled credit and resources into strategic industries like steel, shipbuilding, and electronics. The strategy paid off spectacularly. Japanese cities buzzed with manufacturing might, from Toyota's automated assembly lines to Sony's transistor radios. Rising productivity and exports brought wealth that transformed society. A burgeoning middle class, high rates of savings, and surging consumer demand. By the late 1960s, Japan had overtaken West Germany to become the world's second-largest economy, after the United States. It joined the ranks of advanced nations, becoming an OECD member in 1964 and a founding member of the G7, symbolizing its arrival on the world stage. In 1964, Tokyo hosted the Olympics, showcasing bullet trains and neon skylines to the world as emblems of Japan's modernization. What had been an agrarian, war-torn land was now an industrial juggernaut and a symbol of resilient growth. By the 1970s and 1980s, Japan's confidence and economic clout were soaring. The early 1970s, oil shocks tested the country's mettle. Energy prices spiked, and growth cooled from its breakneck pace. Yet Japan adapted by pivoting to more fuel-efficient production and higher-value technology industries. Automakers rolled out efficient cars that conquered global markets, and electronics giants like Panasonic and NEC led the computer and semiconductor boom. The resilience paid off. By the mid-1980s, Japan was running huge trade surpluses, particularly with the United States, stirring both admiration and friction. American consumers were snapping up Japanese cars and electronics, fueling talk of Japan as an economic superpower. Books like Japan as Number One captured the era's zeitgeist, and Japanese investors began buying iconic overseas assets, from Pebble Beach Golf Course to Rockefeller Center, signaling newfound wealth. But beneath the success lay the seeds of a speculative frenzy. In 1985, Japan bowed to international pressure to address trade imbalances by signing the Plaza Accord, agreeing to appreciate the yen. The yen's value skyrocketed, nearly halving exports by making Japanese goods pricier abroad. To counteract a looming slowdown, Japanese authorities unleashed easy money at home. Interest rates were slashed and financial regulations loosened. This flooded the economy with credit, and with fewer profitable export opportunities, capital poured into domestic stocks and real estate. Thus began one of the most extraordinary asset bubbles in modern history. By the late 1980s, Japan's boom had mutated into a speculative bubble of epic proportions. The Nikkei stock index, which stood below 7,000 in 1980, went on an eye-popping climb to nearly 39,000 by the end of 1989, rising relentlessly every year of the decade. Ordinary people, not just professional investors, dove into stock trading, a cultural shift in a society once known for frugality. Trading floors were packed with eager speculators. One market veteran recalls groups of young office ladies squealing in excitement at stock price displays. It felt like anyone could get rich. Real estate, if anything, was an even crazier ride. Urban land values exploded. In 1987 alone, Tokyo land prices jumped 58%, and a single square meter in the elite Ginza district sold for 32 million yen, about $230,000. The symbolism was irresistible. At bubble peak, the land under Tokyo's Imperial Palace was estimated to be worth more than all the real estate in the state of California. Japanese paper wealth skyrocketed. The stock market's capitalization grew so large that by 1989, Japanese equities made up 45% of global stock market value, dwarfing even the US at 33%. Flush with gains, people spent lavishly. Tales abound of executives buying $1,000 cats as gifts and day tripping by jet to Paris or Hokkaido for lunch. It seemed the party would never end. Yet, even at the height of euphoria, some sensed an insanity behind it. As one Tokyo financier later quipped, "We all knew this had gone crazy, but we didn't really know why." Japan's real economy was strong, but not that strong. This was a mania detached from reality, fueled by easy credit and speculative fever. All bubbles eventually meet reality, and Japan's did so with a spectacular crash in the early 1990s. The beginning of the end came subtly. In late 1989, alarmed by rampant speculation and rising inflation in asset prices, the Bank of Japan hiked interest rates to cool things down. It was like pricking an overinflated balloon. In 1990, the stock market imploded. The Nikkei index plunged from its 38,915 peak down by 50% within a year, erasing trillions of dollars of paper wealth. Land prices, notoriously sticky, soon followed. By early 1992, the bubble was officially declared collapsed as property values tumbled. Tokyo real estate that had soared through the 80s went into freefall. In prime residential areas, land prices fell nearly 20% in a single year. Over the next decade, commercial land in major cities would lose over half its value. The psychology flipped from manic optimism to fear. Almost overnight, Japan's miracle economy was in a state of shock. Banks, which had lent freely against now devalued property, found themselves staring at mountains of bad loans. Corporate balance sheets were wrecked, and ordinary Japanese, once giddy investors, now saw their nest eggs and house values shrinking. The early 1990s brought a profound sense of reckoning. The immediate aftermath was dubbed the balance sheet recession, as companies and households shifted from spending to paying down debt. Economic growth, once a roaring 5 to 10% annually, slowed to a crawl and then stalled. Japan slid into recession in 1992, and what initially seemed like a normal cyclical downturn became something far more enduring. Policymakers were caught off guard by the scale of the bust. The government tried to respond with stimulus packages, pouring money into public works like roads and bridges to prop up demand. and the central bank rapidly reversed course by cutting interest rates. But the interventions were often too late or too timid. A kind of denial set in among financial authorities and politicians. Few wanted to admit that the financial sector was insolvent. For a time, banks and regulators pretended that the bad loans weren't so bad, hoping a quick recovery would magically make those debts good again. It didn't happen. Instead, the delays only compounded the pain. By 1995, the once proud Japanese banking system was in a full-blown crisis. Several big institutions wobbled, and by the late 90s, even major banks and securities firms began to fail under the weight of non-performing loans. The bursting of the bubble had unleashed a financial and economic contraction unprecedented in Japan's post-war history. The stage was set for what would soon be known as the Lost Decade. The 1990s became a period of economic stagnation so pronounced that it earned a grim nickname, Ushinawareta Junen, or the Lost Decade. This was the decade when Japan, the former growth champion, effectively ground to a halt. From 1991 through 2000, GDP barely budged. Some years saw mild growth, others mild contraction, averaging close to zero overall. By one measure, Japan's GDP in 2000 was scarcely above its level in 1991, meaning an entire decade of economic output was essentially lost. Deflation, a general fall in prices, emerged as a pernicious new phenomenon. Year after year, prices for goods and assets drifted downward. While lower prices might sound good to consumers, in practice deflation bred a vicious cycle of pessimism. Consumers delayed purchases expecting things to get cheaper, and businesses, seeing weak demand, froze investment and hiring. Unemployment, traditionally very low in Japan, crept up to post-war highs, albeit still modest by international standards. Consumer confidence hit rock bottom, with households preferring to save rather than spend amid uncertainty. The government's efforts to stimulate the economy often fell flat. A massive increase in public spending in the early 90s provided only a temporary uptick in consumption. By 1998, consumer spending was faltering again. In a fateful move, the government raised the national consumption, sales, tax from 3% to 5% in 1997, aiming to rein in budget deficits. But this tax hike snuffed out a nascent recovery and pushed the economy back into recession. The late 90s also saw Japan hit by external shocks, including the 1997 Asian financial crisis, which further rattled its financial system. Perhaps the most distressing aspect of the lost decade was the paralysis in addressing the root problems. Banks limped along, weighed by bad loans to zombie companies. More on that soon. The Bank of Japan, traditionally conservative, was slow to embrace radical monetary easing. Only in 1999 did the BOJ cut interest rates to essentially 0%, adopting a zero interest rate policy to spur lending. This was a world first. Modern economies had rarely, if ever, experienced zero rates. Initially, it offered limited relief. In fact, when a hint of recovery appeared and the BOJ tentatively raised rates in 2000, the economy slipped back and forced an embarrassing reversal to zero by 2001. Such missteps underscored that Japan was in uncharted waters. By the end of the 1990s, prices had been falling for years, real estate had yet to find a bottom, and the stock market was a fraction of its peak. Socially, the impact was profound. A generation of young people came of age amid hiring freezes and a shortage of good jobs. They're sometimes called the lost generation, as many never found stable career employment. Terms like freeder, perpetual temp worker, and NEET, youth not in employment, education, or training, entered the lexicon, reflecting the human toll of stagnation. Japan had gone from an economic miracle to an example of how things can go wrong, and observers worldwide began to ask, could this happen elsewhere? One decade of stagnation, unfortunately, turned into two and then nearly three. The early 2000s were supposed to mark a turnaround, and indeed there were flickers of hope. But Japan couldn't fully shake off its economic malaise. The government and central bank began to experiment with more aggressive measures. In 2001, the Bank of Japan launched quantitative easing, QE, essentially pumping money into the banking system by buying government bonds in hopes of ending deflation. This unorthodox policy was another first among major economies. The economy responded with a mild recovery in the mid-2000s. By 2005 to 2007, growth ticked up a bit, and inflation even briefly stopped falling. Japan's banks finally underwent serious cleanup around this time. Bad loans were written off, weak banks recapitalized or nationalized, which helped restore some functionality to the financial system. In fact, the BOJ felt confident enough to end QE in 2006 and even raise rates slightly above zero by 2007. But the respite was short-lived. The 2008 global financial crisis struck like a tsunami. As global trade plunged, Japan's export-dependent economy was hit hard. GDP contracted sharply in 2008 to 2009. Once again, the BOJ slashed rates to zero and restarted QE, and the government spent heavily to stabilize the economy. By the 2010s, Japan found itself still stuck in what was now being called the lost decades, plural. Astonishingly, by 2017, Japan's GDP was only 2.6% higher than it had been 20 years earlier in 1997, essentially no growth in 2 decades. Land values, which had slid year after year, only stopped falling around 2018, marking the first nationwide increase in real estate prices, a meager plus 0.1%, in over a quarter century. The stock market, too, never regained its 1989 peak until decades later. It became almost a poignant joke that an entire generation of investors waited nearly 30 years to get back to break-even. In 2012, Japan's leadership tried yet another bold strategy. Prime Minister Shinzo Abe took office and launched a program soon dubbed Abenomics. It consisted of 3 arrows: massive fiscal stimulus, unprecedented monetary easing, and structural reforms. The Bank of Japan under Governor Haruhiko Kuroda went all in. Interest rates were driven negative by 2016, and the BOJ began buying not just government bonds but even stocks and real estate funds, swelling its balance sheet. This policy blitz included huge central bank stimulus and pro-spending budgets. Abenomics managed to jolt the economy modestly. The stock market rallied strongly in the mid-2000s, and unemployment fell to very low levels as the labor force shrank. There were some signs of life. Inflation crept above zero, though far from the 2% target, and corporate profits improved. Yet deep structural issues remained, as we'll discuss in upcoming sections. Growth, while better, remained anemic compared to Japan's past, roughly 1% annually. By 2020, Japan's perennially low inflation even turned negative again in the wake of the COVID-19 pandemic. Moreover, the cost of decades of stimulus was sky-high public debt and a central bank holding assets worth over 100% of GDP. In 2010, Japan ceded its position as the world's second-largest economy to China, a symbolic passing of the torch. Japan still boasted world-class companies and a high standard of living, but it was no longer the growth engine of Asia. Instead, its 3 lost decades became a reference point for other countries fearing Japanification, a scenario of low growth, low inflation, and policy impotence. How did it come to this? To answer that, we must delve into the structural failures that underpinned the stagnation, turning a short-term crash into a prolonged funk. One of the most critical failures was in Japan's banking system. In the 1980s, banks had fueled the bubble with aggressive lending, often using land and stocks as collateral. When the bubble burst, that collateral plummeted in value, and banks were left with a huge pile of bad debts. Normally, one would expect a banking crisis to be met with swift action. Recognize the losses, recapitalize or restructure the banks, and let insolvent borrowers go bankrupt. But Japan took a different path, one of delay and denial. Throughout the 1990s, rather than confronting the bad loans head-on, many banks pretended things were fine, rolling over loans to defaulting borrowers to avoid recognizing losses. This practice was so common it earned a nickname, evergreening, effectively keeping dead loans on life support. The government tacitly supported this approach at first, fearing an outright banking collapse. Regulators were lenient, allowing banks to fudge their balance sheets and avoid harsh write-downs. The result was the proliferation of what came to be known as zombie firms. These were companies that were essentially bankrupt, unable to survive without continuous bank credit, but were kept alive by banks unwilling to pull the plug. By the early 2000s, roughly 30% of publicly traded companies in sectors like manufacturing, real estate, and retail were on life support from banks. Instead of going under, they lumbered on as zombies, tying up capital and labor. For more than a decade, Japan's banking system didn't even achieve a net profit. All earnings were eaten up by loan loss provisions and deadweight costs. The zombie firm phenomenon had toxic effects on the broader economy. In a healthy market, bad companies fail and make room for new, innovative ones. A process economist Joseph Schumpeter called creative destruction. But in the 1990s Japan, creative destruction stalled. In Japan, firms never exited, as one analyst put it bluntly. Zombie companies continued producing, often slashing prices to drum up any business, which led to overcapacity and deflationary pressure. They also hoarded workers, which meant talented employees were stuck in moribund firms instead of moving to dynamic ones. This raised overall costs, as zombies paid wages higher than their productivity justified, and made it harder for new entrants to find labor and market share. The presence of zombies thus reduced industry productivity and choked off innovation. Small wonder that despite zero interest rates and large budget deficits, Japan's economy remained unresponsive. The lifeblood of credit wasn't flowing to healthy growth companies, but rather being sucked up by the undead. Eventually, by the late 1990s, the situation became untenable. A banking crisis erupted when several big institutions, like Hokkaido Takushoku Bank and Yamaichi Securities, failed in 1997. This forced the government's hand. Through the early 2000s, authorities injected trillions of yen to recapitalize banks and set up asset management companies to purchase bad loans. The bill was enormous. Taxpayers ultimately shouldered losses equal to at least 20% of GDP by one estimate. It was a painful cleanup that arguably could have been less costly had it been done a decade earlier. The lesson from Japan's banking woes is stark. Delay only drags out the pain. By keeping zombie borrowers alive, Japan's leaders hoped to avoid short-term shocks, but they inadvertently sentenced the economy to a slow bleed. Another pillar of Japan's structural struggles was its monetary policy, in particular, the Bank of Japan's handling of the crisis. In hindsight, the BOJ has been both criticized for doing too little, too late, and praised for pioneering radical tools when conventional methods failed. During the 1980s bubble, the BOJ arguably let credit grow too easily, then slammed the brakes too hard in 1989. But the real test came after the bubble burst. As the 1990s recession deepened, the BOJ gradually cut interest rates from over 6% in 1991 down to 0.5% by 1995. When that didn't revive growth, they went further, effectively hitting 0% by 1998-1999. This was unprecedented. Japan entered a world of zero interest rates, ZIRP, before anyone else. The idea was to make borrowing virtually free, in hopes that companies would invest and consumers would spend. Unfortunately, Japan had fallen into a classic liquidity trap. With deflation and pessimism, even a zero rate wasn't enticing businesses to borrow or individuals to part with cash. If prices are falling, holding on to money, which gains purchasing power over time, can seem wiser than investing. Indeed, after a mild uptick in 1996, the BOJ believed the economy might be on the mend and actually raised rates to 0.25% in 2000, only to see growth slip, forcing them to cut back to zero within a year. This false start underscored how delicate the situation was. Deflation had become entrenched. By the late 90s, prices were consistently falling year on year. A consequence was that real interest rates, adjusted for deflation, were still effectively positive despite nominal rates at zero, meaning monetary policy was not truly easy in real terms. Realizing that conventional tools were exhausted, the BOJ broke new ground with quantitative easing in 2001. Instead of just setting short-term rates, they pumped money directly into the banking system by purchasing long-term government bonds and even stocks. This policy aimed to flood the economy with liquidity and signaled that the central bank was committed to fighting deflation. The BOJ also explicitly encouraged inflation expectations to rise, hoping to convince people that prices would stop falling. There's evidence these moves had some effect. By the mid-2000s, core inflation in Japan crept above zero and the economy grew modestly, as mentioned earlier. However, critics argue the BOJ could have done much more, much earlier. Some point to lessons from the US Great Depression, where monetary expansion eventually helped recovery, suggesting that if Japan's central bank had been more aggressive in the early 90s, perhaps deflation might never have taken root. Internal BOJ culture and fears of hyperinflation, given Japan's 1940s wartime inflation memory, made the bank conservative and slow-moving. Furthermore, monetary policy was trying to push on a string. Banks, mired in bad loans, were not lending out the money they received. They simply held excess reserves. And companies facing a bleak outlook weren't eager to borrow even at 0%. The BOJ's struggles highlight a structural trap. Once deflation sets in, normal policy levers lose potency. Japan's experience foreshadowed what other rich countries would face after 2008. Near-zero rates and unconventional easing becoming the norm. Even as late as 2023 to 2024, the BOJ was still grappling with how to exit the ultra-low rate policy without disrupting markets, illustrating the long shadow of the lost decades. In short, monetary policy alone could not save Japan, especially when deployed too cautiously at first and against the headwinds of a broken banking system and aging demographics. Stimulus and skyrocketing debt. Hand in hand with monetary policy is fiscal policy, and Japan's experience provides a complex lesson in the limits of government spending when deeper issues are unaddressed. In the wake of the bubble collapse, Japan's government turned on the spending taps hard. During the early 1990s, a series of stimulus packages directed funds toward infrastructure, new highways, bridges, bullet train lines, and even less productive projects colloquially derided as bridges to nowhere. The intent was classic Keynesian pump priming, to replace lost private demand with public demand, thereby averting a deeper recession. Initially, it had some effect. By 1993, the government's heavy spending did lift household consumption slightly out of its funk. But this boost proved temporary. Consumers, worried about the future, soon reverted to saving, and by 1998 consumption was flagging again despite all the public works. One reason was that the stimulus couldn't fully offset the drag from the private sector's deleveraging. People and companies were paying off debts, not interested in new spending. Another reason was policy inconsistency. Concerned about the ballooning budget deficit, officials tried to rein in spending too soon. The infamous 1997 consumption tax hike, from 3% to 5%, was meant to restore fiscal discipline, but it backfired badly, sending the economy back into recession and actually worsening the deficit as revenues fell. This tug-of-war, stimulus on, then austerity, then stimulus again, created an erratic fiscal trajectory that arguably made recovery even harder. The net result of repeated stimulus and economic stagnation was an explosion of public debt. With tax revenues weak in a sluggish economy and constant spending to prop things up, Japan's government debt kept climbing. By the 2000s, commentators warned of a looming debt crisis. Yet paradoxically, Japan could borrow at extremely low interest rates because domestic savers kept buying government bonds, and deflation made investors more concerned with return of capital than return on capital. Even so, the debt numbers were striking. Japan went from a relatively low debt per GDP ratio in the 1980s to having the highest public debt in the world, over 200% of GDP by the late 2000s, and around 250% by the mid-2020. This level of debt had no precedent in peacetime for a major economy. It raised tough questions. Was this sustainable? Thus far it has been, largely because Japan's debt is held mostly by its own citizens and institutions, and the BOJ itself bought a huge chunk via QE. But it also constrains future policy. So much of the budget goes to debt service and social security that flexibility is limited. Importantly, all that spending did not fundamentally cure the stagnation. It cushioned the fall. Unemployment would have likely been higher without it, but it didn't spark a return to robust growth. Japan's experience suggests that fiscal policy can stabilize an economy in distress, but without structural reforms, it's akin to painkillers treating symptoms rather than the disease. The government often found itself building more roads in places that already had roads, because shovel-ready projects were the easiest way to pump money out. Critics argue they should have focused more on forward-looking investments, like education, tech innovation, rather than pork barrel construction. In the Abenomics era, fiscal policy was again used, with mixed results. Abe's government spent on initiatives from childcare to encourage more women to work, to rebuilding after natural disasters, while also eventually raising the consumption tax to 10% in stages to address debt. Walking that fine line between stimulus and sustainability remains an ongoing balancing act. Beyond banks and policies, Japan's corporate sector and work culture have also played a role in the protracted stagnation. During the boom decades, Japanese corporations were lauded for their model of lifetime employment, seniority-based pay, and close alliances under keiretsu groupings. This system fostered loyalty and allowed long-term planning over short-term profits. It was part of the human infrastructure that powered the miracle. Companies invested in workers, and workers devoted careers to companies. However, in the post-bubble world, some aspects of this model became a hindrance. Lifetime employment meant big firms were very reluctant to lay off workers, even when profits evaporated. Instead, they cut hiring of new graduates to reduce headcount over time, which contributed to the lost generation problem. It also meant a general resistance to restructuring. Many firms kept loss-making divisions alive, often with support from their main banks, rather than prune them. Corporate Japan entered the 1990s with arguably too much capacity, factories, stores, etc., and not enough flexibility. Meanwhile, management was often slow to pivot to new opportunities. In the tech realm, for example, Japanese electronics companies that dominated in the 80s, like Sony, Panasonic, struggled in the 90s with the shift to software and digital trends, ceding ground to more nimble rivals abroad. Part of the problem was corporate governance. Cross-shareholding was rampant. By the late 1980s, over 60% of shares in many companies were held by friendly corporations or banks, which insulated management from shareholder pressure. Executives were less accountable for poor performance, and the focus was often on empire building or market share rather than profitability. As a result, return on equity for Japanese firms remained low compared to American or European peers throughout the lost decades. Companies tended to hoard cash and were cautious about bold investments or raising wages. Culturally, Japan also faced an innovation challenge. A stereotype emerged that while Japan excels at incremental improvement, kaizen, and hardware manufacturing, it struggled to produce disruptive innovations or foster startups. There is truth to the observation that few globally dominant new companies emerged from Japan in the 1990s and 2000s, especially in the software and internet era. The likes of Google, Apple, Amazon were American, Alibaba, and Tencent Chinese. Meanwhile, Japan produced few equivalents. Entrepreneurship remained relatively rare, as societal preference leaned toward stable corporate or government jobs. Those who did start businesses often found it hard to get bank financing in a risk-averse financial system. Another aspect was the utilization of women in the workforce. Historically, Japan's female labor participation was lower than many Western countries, and women were underrepresented in management. This meant Japan was underusing a key talent pool. In the 2010s, womenomics became a buzzword under Abe, aiming to empower women economically, and indeed female workforce participation rose to record levels. A positive structural shift, though progress in leadership roles remained slow. By the late 2010s and 2020s, some aspects of corporate Japan did start to change. Under pressure from investors and government reforms, many firms began unwinding cross-shareholdings and improving corporate governance to boost shareholder value. For example, introducing independent directors and stock buybacks. The jobs for life model has quietly eroded, with an increase in contract and part-time workers, now about 40% of jobs, up from much lower in the 80s. However, this has created a dual workforce. Older employees still secure, younger ones often precarious, which in turn affects consumer behavior and fertility rates. Young people uncertain about the future tend to spend, and even marry less. Overall, the corporate sector's slow adaptation contributed to the sluggish recovery. Instead of dynamically reallocating resources after the bubble, Japan Inc. initially froze in place, preserving the old order. This stability had a cost. It dampened the very dynamism that is needed to climb out of stagnation. Only in recent years have we seen a more concerted push to shake up corporate Japan to be more lean, innovative, and globally competitive. Perhaps the most daunting structural challenge Japan faces, one that underlies much of the stagnation, is demographics. Simply put, Japan's population is aging and shrinking at a pace unprecedented in a major economy. The post-war baby boom in Japan was brief, and fertility rates began falling sharply by the 1970s. By the 1990s, birth rates had dropped well below the replacement level of 2.1 children per woman, hovering around 1.3 to 1.5. At the same time, life expectancy in Japan climbed to among the highest in the world, over 85 years. The result is a population that is not only smaller year by year, but graying rapidly. Japan's population peaked around 128 million in 2010 and has been declining since. It's now about 125 million and projected to fall below 100 million in the coming decades if trends continue. More critically, the share of elderly people has ballooned. Nearly 30% of Japanese citizens are now age 65 or older, the highest proportion in the world for any sizable nation. This figure was about 12% in 1990, so the change has been dramatic in a short time. By 2040, it's projected that 1 in 3 Japanese will be elderly. Conversely, the working-age population, 15 to 64 years old, has shrunk. It peaked in the early 1990s at roughly 70% of the population and is now around 59%, the lowest among G7 countries. Every year, there are fewer workers to support more retirees, straining pension and healthcare systems and dampening economic dynamism. An aging society tends to spend less on new houses, cars, and consumer goods. Retirees often live frugally, which is one reason domestic demand in Japan has been persistently weak. Moreover, older societies may innovate less and invest more conservatively, contributing to lower growth. Compounding the demographic crunch is Japan's historically strict stance on immigration. Unlike nations that offset low birth rates by importing labor, Japan has admitted very few immigrants until recently. Foreign workers account for only about 2% of Japan's labor force as of 2018, a tiny fraction compared to 17% in the US or UK. The government and society were long averse to large-scale immigration due to cultural and political concerns, emphasizing social cohesion and homogeneity. Only in the late 2000s and 10s did Japan start modest programs to bring in foreign workers in certain sectors, like elder care, construction. But these are tightly controlled and often temporary. The reluctance to embrace immigration means Japan must rely on other solutions to its labor shortage: automation and mobilizing underused domestic groups. Indeed, Japan is a world leader in robotics and AI, from factory robots to talking companion robots for the elderly, partly out of necessity to replace human workers. And as mentioned, Japan has made efforts to encourage greater female and elderly labor participation. These have seen some success. A record 9 million seniors were working in 2023, many in part-time roles, and female participation is now comparable to many Western countries after significant increases in the 2010s. Still, these measures can only do so much. The demographic headwinds have led to what some economists call shrinkonomics, an environment where even maintaining economic size is difficult, let alone growing, because the labor force is contracting. It also creates a huge fiscal burden, caring for a growing elderly population with a shrinking tax base. Social security costs, pensions, healthcare, are swelling, which is one reason the government has repeatedly raised the consumption tax, a politically unpopular move, but seen as necessary to fund elder care. Intergenerational tension is a new theme, as younger people shoulder heavier tax burdens to support a system from which they expect to benefit less. In sum, Japan's demographic and immigration policy challenges are a slow-burning crisis that has unquestionably contributed to the lost decades. Even if all the other issues, banking, deflation, corporate inertia, were solved, it's hard to grow an economy with fewer and older people each year. Japan's story is a cautionary tale here too, as many other advanced economies are following in its demographic footsteps. The question remains whether Japan can find innovative ways to thrive with a smaller, older population, perhaps pioneering a model of quality over quantity in economic life, or whether the demographic drag will continue to limit its prospects. Despite these immense challenges, Japan remains a wealthy, peaceful, and technologically advanced nation. Its journey from post-war ruin to prosperity, and then through stagnation, provides invaluable lessons. Bold structural reforms, such as cleaning up banks promptly, encouraging innovation, embracing diversity in the workforce, and carefully opening to immigration, might have alleviated some of the pain of the last 30 years. Today, there is a greater awareness in Japan of the need to adapt and change long-held practices. The rest of the world has also learned from Japan's experiences, whether it's how to deal with asset bubbles, or the importance of confronting banking problems early, or anticipating the impact of aging populations. In many ways, Japan was the canary in the coal mine for issues now confronting other advanced economies. And yet, Japan's culture of resilience persists. Even during the lost decades, living standards in Japan remained high, crime stayed low, and the fabric of society held together without the strife that such prolonged economic weakness might have caused elsewhere. This speaks to strengths that aren't captured in GDP numbers. Moving forward, Japan's story is still being written. Can it defy the odds and reinvent its economy for a new era? If any country can harness technology and social cohesion to chart a new course, Japan might be it. Japan's economic saga, from miracle to lost decades, is a powerful reminder that no rise is guaranteed to last forever, and that prudent policies matter profoundly. If you found this deep dive insightful, please give the video a like, leave a comment with your thoughts or questions, and subscribe to our channel. Your engagement not only helps others discover this content, thank you, YouTube algorithm, but also supports us in creating more in-depth explainers. Hit the bell icon to get notified of our next documentary-style analysis. Arigato for watching, and we'll see you in the next one.